It's the most significant tax overhaul since the Reagan administration. It will be felt in every corner of the economy. But it's not the simplification that GOP leaders promised. There are still loopholes. There are 7 tax brackets. And while it does cut taxes across the board, those middle-class tax cuts are modest and they expire. Make no mistake, the centerpiece of this bill is big tax cuts for companies. The corporate rate is slashed to 21% from 35%. The tax burden on pass-through businesses is lowered, with the hope but no guarantee that corporate tax savings will mean more jobs and high wages. Along the way, concerns corporate tax cuts would come at the expense of students, teachers, parents. But this final bill keeps deductions for student loans, keeps tax breaks for grad student tuition, keeps deductions for teacher spending. It doubles the child tax credit and increases how much is refundable, meaning Americans get that money back even if they don't make enough to pay income taxes. Hello, New York, New Jersey, Illinois, and California. No more unlimited deduction of state and local income tax and property tax. Instead, it is now capped at $10,000. That could hurt home prices. So could the new cap on how much mortgage interest can be deducted, $750,000. Homeowners in high-tax states bear the brunt of that. Other potential losers, the elderly. Medicare faces a 4% cut. And people buying health insurance. Eliminating Obamacare's individual mandate could hike premiums. And those individual tax cuts, again, they expire by 2025 to help keep the cost of the bill below $1.5 trillion. The White House says growth will pay for tax reform. A minority opinion. Most scores show deficits up by more than $1 trillion over a decade.
The United States has a problem with income inequality.
Things are much worse today in terms of inequality than they were 30 years ago.
The biggest threat to us as a nation is income inequality.
People have different ideas about why this is happening.
CEO pay climbs every single year without exception.
The United States has lost 5 million manufacturing jobs since the year 2000.
Big shifts that's happened in the economy that has led in part to a decline in union membership.
But one of the biggest drivers of inequality is hiding here in these 2,000 pages. It's the U.S. tax code. President Trump and Republicans in Congress have a plan to alter that code. And if they get their way, it'll get even better for the richest Americans. First, let's look at a few things that Trump and the Republicans don't want to change about the tax code: the charitable deduction and the mortgage interest deduction. Here's how they favor the rich. Let's say Dan makes a $100 donation to his church. He makes about $30,000 a year, roughly the median income for individuals in the U.S., which puts him in the 15% tax bracket. It means he would save, at most, $15 on his taxes. But let's say Dan's boss, Steve, makes the same donation to his church. Steve makes $500,000 a year, which puts him in the top tax bracket. And the same $100 donation could save Steve $39.60 on his taxes. Dan and Steve give the same amount to their church, but Steve saves more than twice as much. The higher your tax rate, the more the charitable deduction helps you. Small examples like this add up. People making $100,000 or more account for about 57% of all the charitable contributions in the U.S., but they get 76% of the tax benefits. This deduction is also really expensive. The U.S. spends $70 billion a year on it, more than 8 times what it spends on Head Start, the federally funded preschool program, and more than twice what it spends on Pell Grants for low-income students to go to college. Plus, there's all kinds of ways to bend the rules. Billionaire Mitchell Rales gets a tax break for donating his collection of modern art to a museum that he built right next door to his house, a museum that's only open for private tours. But the worst thing about the charitable deduction? There's not great evidence that it works.
Turns out you don't need a tax break to encourage people to be generous to others. In the 1980s, the top tax rate for the richest people was 70%, and through a series of reforms, it dropped to 28%. And the Council on Foundations, is kind of the trade group for charities, said, oh my God, you do that, we're going to lose all our contributions. Guess what? No difference. People gave just as much with a much lower tax rate.
Austria, Finland, Ireland, Italy, Sweden, Switzerland, and New Zealand have all gotten rid of their deductions for charitable contributions, and that hasn't had an impact on donation rates. One easy way to make things more fair? Replace the tax deduction with a tax credit. If Dan and Steve both give $100 to their church, give them each a $15 tax credit. That's how they do it in Canada. A tax credit reduces the amount you owe, so the same donation gets the same benefit, no matter how rich you are. There's another tax deduction that's a boon for the wealthy.
The mortgage interest deduction costs about $100 billion a year to the Treasury. We could use that money to treat wounded veterans, to build hospitals, to build highways, but instead we give it to rich homeowners. Here's
how it works. Let's say Dan buys a house for $100,000. He doesn't pay for that all at once. Each month he writes a check to the bank for $1,000. Let's say $800 goes to paying for the house, and the bank keeps $200. That's interest. Dan writes 12 of these checks a year, so he pays $2,400 a year in interest. The mortgage interest deduction lets Dan subtract that interest from his taxable income, which could save him as much as $362. Nice, thinks Dan. That is, until he hears about Steve. Steve also buys a house for $100,000. He also writes a $1,000 check each month, paying $200 in interest. So after a year, Steve can also deduct the $2,400 from his taxable income. But that same deduction can save Steve more than $960, nearly 3 times as much as Dan for the exact same mortgage payments. It doesn't stop there. Steve can buy a second home, deduct the interest, and save even more. Or he can get a mortgage for his yacht, count it as a second home, and deduct the interest. Sorry, Dan, your fishing boat doesn't count. There are deductions everywhere. The money you lose from gambling? Deduct it. Fancy business dinners? Yep. Money you put in a retirement account? That too. You can even deduct the fees you pay an accountant to help you find more deductions. And while theoretically Dan could take advantage of these same deductions, the fact is people like Steve benefit a whole lot more. People who make about $400,000 a year or more make up about 5% of taxpayers, but they get more than half the benefits from these tax deductions. Now, there's a third part of the tax code that Trump and the Republicans want to keep, and it's even better for the richest Americans than all of these deductions: the preferred rate for capital gains. Here's how it works. According to the U.S. tax code, there are 2 different kinds of income.
Earned income is when you go to work and somebody pays you a salary or a wage, a paycheck. That's earned income. And we have a whole set of income tax rates for that income that go up to 39.6%.
This is where Dan and Steve's tax rates come from.
Unearned income means guys who trade paper, guys who sell stock or buy commodities and then sell it. Invest in real estate properties and then sell them. That's capital income, and we tax that at a lower rate.
Let's say Steve earns $500,000 a year as a surgeon, and Lori earns the same amount as a hedge fund manager. Even though their income is the same, Steve's tax rate is 39.6%, but Lori's tax rate is nearly half that, 23.8%. So Steve ends up with a much higher tax bill. This is why billionaire investor Warren Buffett pays a lower tax rate than his secretary. His money comes from capital gains, while hers comes from a salary.
Debbie works just as hard as I do, and she pays at twice the rate I pay.
Ronald Reagan thought the same thing.
Reagan had been a very high bracket taxpayer. In fact, he paid at the 90% rate in the 1950s. He was a movie star. His accountant kept telling him, well, sign these documents and that'll shift your income from labor to capital income. And Reagan saw that was hokey. Why should that be?
Reagan's landmark 1986 tax bill taxed capital income and labor income at the same rate.
In theory, some of those loopholes were understandable, but in practice, they sometimes made it possible for millionaires to pay nothing, while a bus driver was paying 10% of his salary, and that's crazy.
People said, oh my God, you can't do that, then nobody will invest. Investment will plummet. It didn't.
This chart shows the value of the S&P 500, a stock market metric that measures how well big businesses are doing. After Reagan raised the capital gains rate in 1986, businesses continued to prosper. Reagan's successors, George H.W. Bush and Bill Clinton, also raised taxes on the wealthiest Americans. And the 1990s saw America's longest period of consecutive economic growth ever. But the changes that Donald Trump and Republicans in Congress want to make to the tax code look very different. While the Trump and GOP plans get rid of some deductions, Neither gets rid of the charitable contribution or mortgage interest deductions. Both plans would lower taxes on capital income for people like Lori, the hedge fund manager. And both plans would reduce the number of tax brackets from 7 to 3 and cut the top tax rate, which would mean big tax savings for someone like Steve and minimal savings for working and middle-class people like Dan. Rather than working to reduce the growing gap between the richest Americans and everyone else, these new tax plans would make that gap even wider.